despite kind of the recent news headlines with the war and all, we still have good growth and good, healthy economic data. If an investor wants to protect himself against inflation, one of the best ways to do this is to invest in interest-sensitive financials. Well, first of all, so you can understand our perspective, we're investors who really focus on company-specific fundamentals and company valuations. So we are called bottom-up value investors. And when you have all these macroeconomic disturbances, and when you have all these events happening in the geopolitical environment around us, it actually provides opportunity for long-term investors. Why? Because these macroeconomic events move share prices around, up and down quite significantly, whereas the underlying value of the businesses doesn't move nearly at the same rate or pace as the share prices do. So a gap opens up between the stock market price of a company and the underlying value of a business, meaning it provides a long-term investor with opportunity. I do not believe we are in a period of stagflation, because half of the term stagflation is stagnation. The economic data today still shows robust economy. So we don't have a stagnant economy. In fact, despite kind of the recent news headlines with the war and all, we still have good growth and good, healthy economic data. However, we do have inflation. We have inflation, I think, for two reasons. We've had too much fiscal stimulus and we've had too much monetary stimulus. What can an investor do in these inflationary environments? Really, the best investments that you could make are in the financial sector, because banks and insurance companies have been hurt by low interest rates, and now they will be benefiting, all else equal, they will benefit from higher interest rates as their net interest margins will be able to expand again. So if an investor wants to protect himself against inflation, one of the best ways to do this is to invest in interest-sensitive financials like European bank stocks, US bank stocks, as an example. I think if one of the things we've learned as a result of the Ukraine invasion was that the world very, very quickly gathered around the Ukraine and unified around trying to stop the war. And I think this might relate to Taiwan as an example. I think the Taiwanese people, if anything were to happen to them from a war and violence, I think they should be gratified to know that the world would rally around them. I think it's two different situations, two very different situations, but I think it's one thing that's clear is that the world doesn't really want war or will tolerate war. I think it would be a very negative impact. You saw the impact that the markets have felt as a result of the Ukraine invasion. And I think an invasion of Taiwan, as unlikely, I hope, as it is, would even have greater ramifications on the markets. Again, I do not believe China just made some announcements earlier in the week that they do not want to use military to reunite Taiwan, and hopefully they are very serious about it. But I think it would have a very damaging impact on the global equity markets and on the global economy if this were to happen. Now, I think, as I mentioned, as we are now entering a period where interest rates will rise, and that instead of buying companies that benefit from low to zero interest rates, you should be buying companies that benefit from higher interest rates. And this kind of leads us to kind of value stocks. Companies such as industrials, companies, as I mentioned, such as financials. These are the businesses that will do better in a higher interest rate environment. And this is where investors should be looking for investment opportunities.